If it's not cash flow, then what is it? Most people think real estate's about the assumption, uh, and that keeps them stuck. Watching from the sidelines, the truth is real estate's about structure, how deals are designed. It's about control, how risk is managed, and how capital is attracted, not chased. This show exists for people who don't want information. They want to learn how to execute. I'm Mike Morowski. I'm a real estate investing coach who teaches investors how to acquire, finance, and manage real estate with little or no money down by mastering terms, leverage, and deal structure. Look, markets change, rates move, but structure works in every cycle. Control works in every cycle. Real estate isn't bought with money, it's bought with the structure and the control. This is the Mic Drop Show. Good morning, everybody, and welcome back. Grab your coffee and settle in. You're in for a big ride this morning. If you're driving to work this morning, that's fine. Just don't take notes while you're driving, all right? I'll tell you when to write something down and you can catch the whole episode later. So listen, last week I did something on this show that I knew was going to frustrate some of you. And I got the emails, I got the messages. A couple of you were pretty direct about it. And I appreciate that. I love the comments. I love the commentary afterwards. Last week I spent the whole episode telling you that cash flow is not the measure of a good deal, that it's a byproduct, that it's the result, not a reason. And then at the end of the show, I told you I wasn't going to tell you what replaces it. And then somebody wrote me and said, Mike, that's like a doctor telling you that you have cancer and then walking out of the room. And you know what? It's a fair assumption. I agree with that. So here's what I said last week and why. I said that partial understanding is dangerous, and I still believe that. I didn't want to hand you a checklist and make it easy for you before you understood why the old measurement was broken. Because if I give you a framework before you're willing to let go of the thing that you're actually leaning on, and you don't adopt the framework, you just add it to the pile of other stuff that's there. And now you've got two ways to fool yourself instead of just one. But a week's gone by, and if you sat with it, you earn the answer. So today, I'm going to give it to you. Today, I'm telling you what structure and control actually means. Not just words, not just slogans, but four things. We're going to walk through all four. And by the end of the episode, you're going to have a different set of questions to bring to the next deal that hits your inbox. So you might have a different set of questions for me too. But you know what? When you look at a deal after this, you're going to look at it in a whole different way. So let me frame this before we get into it. When I say structure, most people hear financing. Financing is part of it, but that's not the whole thing. Structure is the set of conditions that determine what happens to you when things don't go according to the plan, right? Read that back. It's worth repeating back to you. Here's what happens to you. Structure is the set of conditions that determines what happens to you when things don't go according to plans. When things don't go according to the the business plan, the operational plan, the financing plan. Because here's the thing nobody says out loud. Every deal you have or every deal you've ever seen, every offering memorandum that comes across your desk, every pro forma somebody sends you, every spreadsheet somebody sent to you, every underwriting, those are all built on a version of the future where things go reasonably well, right? We're saying reasonably well. It's like when I first got in the business, I knew nothing about syndications. I knew nothing about the multifamily business. Here's what I knew. You raise money from private individuals, you marry it with a great real estate deal, you stay in the middle, and as long as everything goes well, Everybody does well. But nobody underwrites a deal assuming they're wrong. That's not how anybody thinks. We build the model, we believe the model, and then we go raise money against the model. So we talk to investors and we raise capital based on the model that we built. Structure is the part of the deal that decides whether being wrong costs you a bad year or costs you the whole thing. That's it. That's the whole distinction. Same property, same market, same rent roll, two different structures. One of them survives being wrong, one of them doesn't. So let's talk about the four parts that go into this. So, number one is the terms. And I want you to write this down. Price is a story, terms are the truth. Price is what everybody argues about. Price is what the broker leads with. Price is what shows up in the beginning of an OM. Price is what you tell people at the meetup. Terms are what actually happened to your money over the next 5, 7, 10 years. Let me give you an example of that from a deal that I did. I told you a piece of this before, but I want to, show you behind the curtain a little bit more here today. So last year I bought a 65 unit apartment deal, basically no money down. And the seller is holding a second mortgage of $1 million at no interest for 10 years. Let those terms digest a little bit. Now, if you look at that deal on price alone, somebody's going to tell you I overpaid. And on a pure price per door basis, maybe they've got an argument. I don't believe it, but maybe they do. But here's what price doesn't tell you. That $1 million sitting behind me at zero interest is $1 million that isn't demanding a debt service payment every month. It isn't sitting on my debt service coverage ratio. It isn't showing up as pressure when I'm in the midst of renovations or turning units. So, what did I actually buy? I didn't buy a discount, I bought time. I bought room to be wrong. And that's the trade. You can pay for terms. You almost always pay a little bit more for terms. And it is almost always worth it. So here's the shift I want you to make. Stop opening with what do you want for the property? Start opening with what do you need for the property? Find out what the seller's problem is. Solve the seller's problem. Come up with a solution for the problem, but you have to ask the right questions to find out the problem. Because the seller who needs certainty by a certain date or the seller who needs monthly income is a completely different seller than the one who needs the highest number. I've had sellers take less money because we solved a tax problem for them. I've had sellers take less money over time because we let them stay in the building. I've had sellers hold paper because they liked what we were going to do for their long term goals and for their residents. You don't find that in a spreadsheet. You find it in conversation. You find it in the questions that you ask. You know, the better questions, the more questions, the better answers, the more answers you get. And I want to steer for a second because this is where most people leave money on the table and they don't even know that they did it. Think about my very first deal. I've told a story, 4 unit owner financed. I put $1,000 to when I bought it, and that $1,000 is not. It wasn't no money down, but it was a little money down, and it gained me $450 a month in positive cash flow, and it gained me quite a bit of equity when we sold out of the deal. So I'm not going to here and tell you that it was a win all the way around because there's always challenges along the way, but it goes back to the foundation and the control. So why did it work? Or why did it work? Well, it didn't work because I was a great negotiator. I was I was terrible. It was my first deal. My knees were knocking. It worked because the seller didn't want a lump sum. He wanted a monthly check. He just didn't want to manage the property anymore. He wanted income without tenants calling him in the middle of the night. He didn't figure that out because I was smart. I figured it out because I asked him, "What are you going to do with the money?" That's the whole question. What are your needs? How do we solve that problem? And he told me. And once he told me, the deal structured itself. So the lesson isn't seller financing. Seller financing is a tool. The lesson is the terms come out of the understanding what the person on the other side is actually looking for, what is solving their problem. And you know what? This is why I get frustrated. When people tell me the market's too competitive, the market is competitive on price, it's wide open on terms because almost nobody's having that conversation. Almost everybody's just submitting a number and hoping that the number is the number that the seller is going to take, that it's the architect for the debt. And this is the one thing that puts people out of business. I don't mean the rate. I don't mean just the price. You know, everybody's obsessed with rates and pricing. You know what? I always want to ask three questions about the debt, right? That the seller has in place. Question one: when does it mature? What has to be happen on the date that the loan matures? Does it get refinanced? Do you have to sell? Is it a balloon payment? What happens if you don't pay that debt when it matures? You know, what's the interest rate of that debt? What are the monthly payments of that debt? That's the whole conversation. Once I find the seller's problem, once I can start to find out about the mechanics around it, then I get to have that conversation on how do I solve that. Um, Here's what I find happens to a lot of people. In the last few years, I've watched it, and some of them were friends of mine. They bought a deal in a great market with a bridge loan. They had a 2 year clock on it, maybe with a year extension, and the extensions had conditions on them, and the extensions had rate increases on them. And the whole plan, the entire plan was to refinance, but the rates went up. Now, refinance out of what? Because there's nothing there anymore, and you don't have enough capital in the deal. So that's somebody else's plan. That was the bank's plan or assumption that in 2 years things were going to change. And the market moved. They didn't see the cash flow problem. They didn't look ahead. They didn't have time. So collecting rent became a problem. Debt maturing became a problem. The clock ran out, and the exit that they had assumed was gone. It either sped up or was nowhere to be found. So let me say clearly, you can lose a property that's full, you can lose a property that's profitable if the debt matures into a market that won't refinance. That's a structure failure. That's a control failure. That's not a management issue. It's not an occupancy issue. That's structure. So when you're looking at debt, long and boring beats short and clever. You know what? I have this conversation with people all the time. The difference between term and floating. I love fixed rates. Fixed rate debt that has a long maturity date on it, that's far enough out that can't, that you're going to be able to go through one or two market cycles. That's not being conservative, it's being competent and it's running the deal correctly. And if you do use bridge, if there's a real business plan and the bridge is the right tool, which sometimes it absolutely is, then you underwrite the extension, you underwrite the rate cap, you underwrite the convenience, and you have a second exit plan. You know, I always tell people have an exit plan before you get to the acquisition closing table. Have more than one exit plan. that doesn't require the market to cooperate with you. You know, it's so funny that if the market changes and you get jammed up, well, it's just because you didn't plan properly. So let me define what I mean by a second exit, because people nod at this and then they don't do it. A second exit is an answer to this question: what if I can't refinance? And what if I can't sell at the number that I thought I could sell at because the market shifted, occupancies dropped, NOI went down? Can I extend? Can I bring in preferred equity without giving away control? Can I sell a piece of it off? Can I do a supplemental loan? Can I raise additional capital? Can I hold it longer because the debt lets me? If you can have an answer to these questions written down before you close, you have a second exit in place. If you don't, you have one exit. And now you're backed into a corner. And one exit means the market decides, you don't decide on the business plan. You know what? And I want to be careful here because I'm not telling you this to make you afraid of debt or deals or moving forward. That's not the enemy. Leveraging is the entire reason this business works. You know, look at a deal that you pay cash for versus a deal you have leverage on. Which is a stronger return? You know, you can end up being in a better position. Okay, so the third pillar that I want to talk about, and this is my favorite one, is margin. Here's the question: how much has to go wrong before you're in trouble? Not what's the return, not what's the cash on cash, not what the IRR is. How much has to go wrong? And there's a number that answers this for most passive investors. Never ask for it. It's the break, it's your break even occupancy. So have some coffee. What percentage of this property or this building has to be full to pay the debt service, to pay the operating expenses? Is the answer 80%, 78%, 87%? You've got room, right? You So make sure you underwrite and put a stress test on that underwriting against the rent roll, against a bad quarter, against a bad 6 months or a market shift. You can buy a bad property, turn it around in 6 months, but what happens if the market shifts and that property reduces again? You have almost no room. And I want you to hear this: the deal can look beautiful on paper, the deal can project a great return, and the deal can cash flow month one, and it is one bad summer away from a capital call. So go pull the deals you're looking at right now and find the number, whether it's a 4 unit or a 400 unit. If it's not in the OM, ask for it, figure it out, and ask the sponsor, can they tell you, or will they tell you? You've learned something more valuable than just a number. The same thing on the operating side. You know what debt service is. It has to be 1.25. And if you fall below that to 1.05, what happens? It's a different world. One of them is business, one of them is a tightrope. And I'll tell you where I got religious on this. I've had losses in the business. I've said that on this show before. And when I go back and I look at deals that really hurt me, the common thread wasn't that I bought a bad building. The common thread was I had no room for error. I had built something that required everything to go right. Margin. You've got to look at your margin. Margin is what buys you the ability to be rational, to be a rational person in a bad market. Write that down. Margin buys you your judgment back. And here's the uncomfortable part about margin: Margin costs you something. It always does. Margin means you don't leave, or margin means you don't lever up as high as you could. Margin means you project returns lower, and you have to be okay with that. You have to be genuinely okay with that because in a good market, margin makes you look like a hero. In a bad market, it could totally kill you. So let's jump into the fourth thing, and that's control. And I love control because real estate is all about control. And this is the one that almost nobody ever talks about. When a deal goes sideways, and someday one of them will, maybe a couple of them will, who makes the decisions? Who can force a sale? Who can force a capital call? Who has to approve a refinance? What happens if a capital call doesn't happen? What happens if the sponsor can't perform on their piece? What does the operating agreement say? One thing I want to say in the midst of all this is this is such a people business. We're dependent on each other. We're dependent on that property manager. We're dependent on the property management company who manages the manager. We're dependent on the people who are asset managing the asset. We're dependent on the LP who puts money into the deal. It's a world that we're all dependent on each other. And you don't build this business on your own. You build it with others. You build it as a team. And that control piece is really important. The control you get from the seller, the control that you have throughout the deal. And what happens if you have to remove somebody or push somebody aside? What does the lender get to do when things happen or deals go sideways? I've watched deals where real estate was fine, the property was fine, the residents were fine, and the partnerships blew up because nobody had ever read the documents carefully and everybody still liked each other. You know, the time to negotiate control is when everybody's happy because that's the only time anybody's reasonable about it. Nobody thinks about it before. So ask who decides. Ask it out loud. Ask it in a room before you wire money. And I'll tell you, as the guy on the other side, when a potential investor asks me who decides, I don't get annoyed. I get relieved because then they know. Then because that's an investor who's going to behave like an adult in a hard moment. And control isn't only about partnerships, control is about you too. Who controls your timeline? If you have to sell in 18 months because of how you funded your equity, you don't control this deal. You don't control all the capital. Who controls the operations? If you've got a third party management company and no real reporting rhythm, and you find out about a problem 90 days late, you don't control that asset. Listen, we've had a couple of assets even recently where we just let property management companies go way too long. And because of that, we ran into some issues. You're starting to receive news 90, 120 days after things happen. Who controls the information? Who's getting the information? But is the information you're getting the right information or are they lying to you? So, you know what? Control is a chain. Capital, timelines, operations, information. It's only as strong as the weakest link, right? Let me say that again because a chain is only as strong as its weakest link. And I'll say this to the passive investors listening this morning because a lot of you are. You have more leverage than you think you do before you wire. Before you wire, you have all the leverage in the world. After you wire your money, you have almost none. So use that time wisely. Ask the uncomfortable questions on the front end. A good sponsor is going to respect you for that. They're going to be the ones that are going to give you the answers, not the answers you want to hear, but the truth. So let's kind of recap a little bit on some things. Terms, what actually happens to your money? Debt, when does the clock run out and what's the plan? The margin, How much has to go wrong before I'm in trouble? And who decides when it does? That's structure. That's control. That's the whole thing. What I meant last week when I said cash flow is a result, because look at those four things. None of them are things you can't see in a monthly statement. Every one of them was decided before the deal ever closed. That's why I keep saying you can't fix bad structure with good management. I've tried. I've worked 7 days a week trying to out operate a deal that was badly built, and you can't do it. You just can't. You can lose slower. You just lose slower. But if the ship is sinking, it's sinking. And here's the flip side, the good news, right? That's the bad news. Here's some good news. A well structured deal is remarkable at forgiving. You can have mediocre year. You can have a property manager that you have to fire or change. You can have a bad market cycle, and the debt absorbs it because you built room into it. The time and the control absorb it. So, what do you do with this today? I'm going to give you three things, and I want you to actually do them this week. So, first, take a close look at every deal you're working on, or maybe even every deal you've passed on. Is there a place you can go back and maybe structure that deal differently? Find a maturity date on the debt, put it on the calendar. And then and this one's free. Call one seller this week and don't ask what they want for the building. Ask them what they're trying to solve. What's the problem in their life? And you get there through some questions, right? What are you doing with the money when you sell the property? Where are you moving to? What do you do? Why are you selling today? You know, get into the questions, build rapport, build conversation. And if you don't know how to do this, I'd be more than happy to have a conversation with you offline on the questions, the structures. I have lists of questions that we ask sellers when we're walking deals, when we're talking to them about their deal. I said a couple episodes ago, the better questions we ask, the better answers we get. This is why. That's exactly it. So listen, I know this one was a little heavier and what I usually do on Wednesday morning, but you asked for the answer. And I'd rather give you the real answer than an easy one. And if you're just sitting there thinking, man, I don't know how to do half of what you just said, good. That's an honest answer. That's a better place to be than thinking you had it all handled. That's what I do with people. I work with them. We walk through actual deals. Look at terms. We look at structure. We look at documents. And I show you where the fragility is in hiding before you wire the money, not after. I've got another live masterclass coming up. Watch for details on it. And we're going to go deep on exactly this, the structure side, the term side, the control side, how to build a deal that survives being wrong. And if you're thinking, I want to be a real estate investor, I want to do this myself, or better yet, I want to do this with somebody who's already made the mistakes, then reach out to me. I'd love to have a conversation with you. Subscribe to my channel. We show up here every Wednesday morning at 7:30 Pacific and 9:30 Central Time. Next week, we're going to get into the one that I've been promising you. The first deal that actually worked, why it mattered, and why it almost taught me all the wrong lessons. Because success without the right framework is more dangerous than failure. And if I'm living proof of that. Hey, thanks for being here this morning. I appreciate you. I appreciate you listening in. If you know somebody who needs to listen to this episode this morning, please forward this on to them. You know what? Real estate isn't bought with money, it's bought with structure. It's the control that we put in place. This has been the Mic Drop Show. I'm Mike Morowski, and that's it for today. We will see you next week. Thanks again for being here, everybody.